Hi, welcome to the 2026 market forecast for the Columbus, Ohio real estate market. I'm Ryan Deeter with Real of Ohio, and in this video, we're going to dive into the 5 particular things that I think are going to make the biggest impact on the Columbus, Ohio real estate market. And with that said, I'm going to actually recap what I did last year. I've done these the last few years. So I'm going to recap what I did last year and see how accurate I was so you can decide if you even want to watch this video in the first place. So with that said, I got a bunch of stats and data to pull up for you. I'm going to share with you as we go through this. This is typically a little longer video than I normally produce. I'm going to try to make this quicker than I have in the last few years. If you've watched this last few years, they've taken like an hour. I'm going to try to do this a little bit quicker so you guys can digest this really quickly, which means I'm not going to dive into the data quite as deep as I have in the past. If you want to continue a conversation, if you want to know what the market, deeper, do a deeper dive, I'd love to have a conversation with you. Hit me up, shoot your email in the comments or reach out to me directly. I'd love to have that conversation with you. With that said, let's dive into the stats and data that I put together for you guys so we can learn what's going to happen in 26. All right, I've got a whole slide deck to share with you guys, keep me on track so I can keep this as brief as possible, but as impactful as possible. But first of all, if you don't know who I am, I'm Ryan Deeter. I'm with Real of Ohio. I just switched brokerages a few months ago, so that's another video. If you want to go back and watch that, you can. But that's the big change for me in 25. And I'm going to dive into kind of what happened in 25 here as well. Recap what I predicted last year. I do these every year, so you can go back and watch my video if you're bored. But let me recap what I said last year for you, so we can kind of get through this quickly as well. I said rates will remain about the same. This is interest rates, of course. I'm talking about 5%, give or take. I think they dropped a little bit when we talked about started that. So hit that pretty close. The fundamentals of real estate will be more important than ever. This is kind of subjective, but I believe this really has been true to this last year. Location, condition, and market timing are huge factors right now. We'll see modest growth again in the 5 to 7% as a whole. Not all areas remain the same. So I kind of got 50% there. We saw less growth than 5 to 7% as a whole, closer to 3%. So definitely kind of over predicted what the growth would look like. But definitely not all areas the same. There's some areas that actually hit some double-digit growth marks, and some areas that hit negative marks. So 3% on as a whole, kind of overshot that a little bit. So it was off on the mark on that. Neighborhoods will continue to see different results, with suburbs continuing to lead the way, along with established city neighborhoods. Yeah, this I kind of nailed on the head. Again, with the market growth, I kind of talked about. I was a little bit, surprised to see less growth than what I predicted. At the same time, this is very true, where certain neighborhoods with typically good school districts and desirable walkability and or desirable areas are continuing to see growth in the areas that are really shot up in COVID. The areas that the south side of Columbus and some other areas of the Columbus city really have slowed down, and we saw tremendous growth in 2020, the pandemic era, and a lot of investment, a lot of investors. Heavy areas have really seen slower growth, even some negative growth in those areas, especially. So, and I think this is where the 2025 theme for me has been: we are in a not a recession or negative, but we're in a correction where growth is slower, which means that people can catch up to the growth. We're correcting from the massive growth we've seen in 2020 to 23. We're seeing that really come to an end, and we're seeing modest growth, where average growth is at 5 to 7 for Columbus. And so we're seeing below average growth, which means that we're in that correction period. So that's kind of what the 25 theme was. Oh, sorry, skipping ahead here. Sorry about that. So Columbus will continue to fare better than the national market due to the strong population industry growth. That is true. The national market, Columbus is one of the strongest growing cities in the country still, even though the Columbus had saw slow growth. A lot of areas in the country even saw negative declining prices. So Columbus still saw positive growth, which is better than a lot of areas can say. We will continue to see seasonal cycles, and spring will be competitive with a slowdown in the fall again. Yeah, I mean, I can show you the stats, and I will here shortly, that the spring market continues to dominate, when price increases happen. And in fact, it's a very obvious when I show you this chart that I love to show people, buyers, sellers, to kind of help maximize their potential there. And lastly, interest rates are the single greatest influence to the market. If they get back to 5% range, we will see a much faster growth, but the opposite is also true. If they stay in 7% range, we'll continue to see a slowdown and even year over year price dips in more areas. So once again, we didn't hit the 5 range. We got close. I mean, there was a point where it hit like, maybe 6, but never quite got below 6 on average. And so we never really saw in this. And it also didn't stay in the 7 range. So that's where it's hard to say, if this is right or not. I think it really kind of showed there was no huge fluctuation in interest rates. They did come down off the high in 25, so that helped. And I think that's becoming more normal. We're seeing a normalization, and I'll talk about that too moving forward. A normalization of rates kind of steadying where they are. So all right, let's go into the actual recap of 25. What happened? So that was my prediction. So I think I alluded to some things here. My prediction was we'd see, slowdowns in some areas and not others. The Columbus sales actually rose, about 3%. So the number of sales rose, and so did everything, median price, and average price square foot, all were positive. So this is a little hard to read if you're following along here, but I'll read it out. Median price was up to 2.7%. That's compared to 5.9% in 24. Average price was up 3.1%. That's compared to 5.1% in 24. And average price per square foot was up 2.7% compared to 4.7% in 24. So you see modest, almost half the growth we saw last year. And when it comes to pricing, so prices, price growth has slowed down, quite a bit. You can say quite a bit, 2 to 3%, 2.5%, which is not a drastic amount, but when you're, at 5, that's, half, almost half of what the growth was last year. So just slower growth as, we kind of the theme of this year was affordability. Affordability was very tough. And so we saw that the growth of the Columbus market slowed down. Days on market are up 36 days. That's 20% more than what it was before, which 20% sounds like a lot, but it was really only 31 days to 36 days. So not a ton, a huge jump there, but still 20% more when you're down to, it was like 10 days, during the COVID days. So um, we start pretty low. Then the percent of original list price received. This is a really, fun number to think about, like what sellers are listing their house to what they're getting, the negotiations that are taking place. You're seeing a 2% difference between where the sellers start and where the sellers finish. So, that also, that also talks about, there's still houses that are selling for over asking, but there's houses that are getting negotiated down even more too. So there's still, everything in between. Just think that's still very close to the original price that the sellers are listing their house for. But during the COVID years, it was over 100%. The average was getting more than the list price. We're back to a normal, below list price number now. Inventory is up 2.2%, 2.2 a month, which means in 2.25 essentially months, that if no new houses hit the market at the rate sellers are, or sellers are selling, so the rate the houses are selling in 2.2 months, those houses would be gone if no new houses hit the market. That's up 15% compared to 14% in 24. So you see it's still growing. The inventory is rising, and yeah, so that's giving buyers more options, and that's why we're seeing that the original list price received come down as well. These numbers are based on the data that the Columbus Board of Realtors puts out for us, and I have the chart here. We'll just jump into this here. So you see this is the chart that I kind of get most of the number for, and honestly, we don't have December's numbers out yet. This is still early January, so the numbers don't come out till about a month after. So really late January did we get the numbers, but you can kind of guess what these numbers. This is year to date, so they'll fluctuate a little bit based on December's numbers, but not terribly on there. So I do want to talk about average interest rates. Kind of where those were last year. So I'm jumping around here. The average interest rates was about 6.6% through the year. The high was 7.25. That was early on in the year. And the low was 6.15. That's really where we're, kind of towards the end of the year. In the fall, we saw those dip. we're currently around 6.3, so not too far off that yearly low. And we'll talk about the future here in a minute. But yeah, this is just the chart that the Columbus data puts out for us. I kind of just spoke on that, so we'll skip over that here. Um, the This is a chart put out by FHFA. Sorry for being cut off there, but FHFA, ranks all the cities in the country kind of based on growth and appreciation. And you can see here Columbus was up 3% year over year in 25, and according to their data, which makes it the 37th uh, average, metro in the country. You can see here's the top, 20. And then the next 20 here, where Columbus is at 37, right underneath Minneapolis, Detroit, Dayton, so those cities there, just in front of Kansas City as well. And you can see here, the Northeast really still dominated the market for the most part. You can see a lot of New York, New Jersey's, Pennsylvania, New Jersey, Connecticut. The Northeast still is very strong. Midwest, still had a strong market. Cleveland's up at number 13. But these are all still very modest numbers outside of the first few, really. You're seeing, close to 10% in Allentown there, Pennsylvania, New Jersey border there. So Buffalo saw strong growth as well. Here's the bottom 10 or bottom 20. It's always fun to see the bottom 20. And this is kind of to the point of, Columbus still, is a very, healthy city in a sense compared to the bottom 20 where we saw, some places saw double digits negative growth. And honestly, as a buyer and obviously as a seller, it's pretty clear that as a seller, you don't want numbers to go backwards. But as a buyer in a market, you really don't want your market to go backwards. Really doesn't really a backwards market really doesn't benefit anyone until the market corrects. You can say maybe then it benefits buyers. But what happens in a market that's going backwards, buyers get gun shy because no buyers want to buy a house and then the next year their house be worth less. So if buyers think the market's going backwards, they're going to really hesitate to even purchase something in the first place. They're going to say, I want to wait till it bottoms out before I buy. And it's hard to know when it bottoms out. The only way to know it's bottomed out is when it starts to correct and you start seeing prices go up. And then you're too late as a buyer because, so you can maybe guess and get it right, but it's really just a guess of when the market's going to bottom out and correct. So anyway, so long story short, it's never a good thing when a market's going backwards. Slow and steady growth is a healthy place to be for both buyers and sellers, where sellers are still getting more on average than they would have last year, but buyers have a chance to catch up, save, and be able to purchase. And the numbers aren't getting out of control. The prices aren't getting running away from buyers that are trying to save to purchase the house. So, anyways, you probably all have heard some news about Florida, the Texas market, and the Southwest, really the deep South, really struggling right now because of the amount of um, new builds that are down there and the overbuilding, but also the amount of people that had to go back to, the major cities to work that moved to these areas because it was cheaper. And then all of a sudden they were, had to go back to the other cities to relocate again. All right, here's Columbus City, or Columbus's average or median price chart. Again, this is kind of just, a nice little piece that I love this chart. This is one of my favorite charts to show consumers, hey, every January the market bottoms out. It peaks in June, really May, June, and then it comes back down summer, fall, levels out in this, goes bottoms out in the winter, peaks back up. It's happened, really it goes to 15 the last 10 years, but if I went back another five, really since 2012, we'll see this same pattern. All right, this is the change. This is Columbus compared to the US. You can see Columbus is really mirrors what the US does, but it's just ahead, when it comes to pricing. So it is higher and a more expensive market than the average country in the country, but it's still mirroring the country and what it's doing. So kind of, just kind of a good taste to show like what the country does. That's probably where Columbus is going to fall as well. So kind of following the trends of the nation. So, all right, and you can see here, this is the kind of goes back to 27, so you can kind of see the dip, what happened there, and you can see the spikes. This is cumulative growth by quarter that the FHAFA puts out for us. And, you can see here, we've got negative, decreasing prices to positive growth, spikes in 2020, 22, then, more corrected, what I call the correction. I'm dubbing the 25, 24, really, 23, you can see here to 25, the correction of the 20 to 23 market. All right, looking forward. So I want to talk about, what I think is going to happen the next year, and you can follow along and see if I'm correct or not. If you want to point anything out, make comments, leave comments, anything that you think is going to influence that I missed, please feel free to leave a comment. Love to have a conversation with you as well. Here are the five major influences on the market, and these are the five influences that I think really affect any market. And so we're going to talk about specifically how this affects Columbus and give you guys kind of confidence to make decisions moving forward. So the first one's going to be interest rates. And interest rates, have settled in the 6 to 7% range this past year. We really saw, high, get up to seven and kind of low sixes, but it's really settled in that range. And I would tell you this has become the new normal. Buyers and sellers are no longer talking about, oh, you hear it every once in a while, but they're not as much talking about, oh, 3% interest rate. I'm going to wait for it to come down to 3% anymore. No one's talking about, hey, I'm going to wait for 3%. I'm going to wait for 4%. They're like, no, I've got to figure out how to get my payments, where I can afford the payment at a 6 to 7% interest rate. That's the conversations that are happening. So this is the new normal. This is what consumers and even professionals believe that it's going to be for a while in this range. Maybe they're saying it's going to get in the fives, and we'll talk about that. But most believe we'll see slightly lower rates in 26, saying maybe 1 to 2 cuts by the Fed that help lower rates, and maybe we get in the fives. Maybe the high fives is kind of the best I've seen. No one's predicting anything crazy like in the fours or threes for sure, but they're saying maybe we dip down to the high fives, and that opens up some doors for buyers and it actually makes it more affordable. Because this is a really big thing, and affordability is, the 25, you've heard this left and right. Affordability is an issue. Affordability is an issue. And the interest rate's the fastest thing that can really impact affordability. Now, outside of prices coming down, and this is the one thing that can impact it without, really damaging the market, in my opinion, without having consumers lose money, especially homeowners and buyers. Again, going back to my point on prices coming down, that is not great. And that's why the South and a lot of people in those areas really want interest rates to come down because that will help the burden of those prices coming down. And it helps save sellers from having to sell for less than they really want to because of the affordability side of things. It makes it more affordable for buyers. And again, buyers, in those areas when they're seeing 10% depreciation, what investor, especially in this Florida, those coastal Florida areas, what person wants to, buy a property on the coastal Florida and then realize their property is worth less next year? Most of those people are investors. They're trying to buy something that's going to be a second home or an investment in some way. And investors are really smart with their money. They're not going to want to put money, or buy something, then it'd be worth less when they can put it in the stock market. They can put it somewhere else and make it, and make more money the next year. So, anyways, I think again, we're going to see, I think my predictions we'll see high fives at best to low sixes, the average in 2026. So somewhere around that 6% range. And a lot of people are just in the wait and see mode. No one's really confident about what rates are going to do. There's a lot of politics behind this right now, and when it used to not be a very political thing, it's become very political. So that's another whole factor. But the who sets the rates is it's a committee. It's not just one person. So there's a committee that's been there, and that committee is not going to change drastically. There's talk about the Fed chair being replaced with one of Trump's close allies, whatever you want to call it. But it's just one person that's not going to make a huge difference in the whole committee's decision. All right, I'd like to show this chart. This is the interest rates from really 90, 1970 to today. And you can see, you'll hear your parents talk about this area right here. 'Cause this is where, if you're buying a house, you probably know someone that bought a house in this range and how crazy it was then. Obviously, prices were much lower, so it didn't make as drastic as an impact. If interest rates are in the, 20% right now, that would drastically change the market we're in. Even, going from three, you can see here it got up to 20s, went down to the, 3% range slowly and steadily with ups and downs along the way. and we got up to seven, from 3 to 7, and this is what killed a lot of people. And this really the hard part of this was that you were in the three range, 3, 4 range, and you shot up to seven very, very quickly. Just like here, where you shot down very quickly. I'm sure there was a big boom and buyers getting in the market. Where here it shot up so quickly that it just was a really tough situation where people were so quickly taking, like, the rug was kind of pulled out from buyers that were considering buying in this window. All of a sudden they looked at their payments would be almost twice as much because the prices increasing and interest rates increasing at the same time. So that has now been steady, and so now we have a couple of years of those prices and the interest rates kind of leveling off, and we're seeing it actually come down, tick down a little bit. So we're kind of at the lower range of where it's been since it shot up. And so that's kind of getting buyers an opportunity to kind of enter the market again. But all right, this is mortgage application. So buyer demand. So real estate's really not that complicated. It's not. I always tell people it's not rocket science. It's really two things: supply and demand. So what supply is out there and how much demand's out there is going to help kind of depend on where the pricing is going, what's going on. Is it obviously during COVID the demand was so high and the supply was so low. It was the perfect storm of why prices shot up. And so now we're seeing more normalized supply and more normalized demand, and we're seeing a more normalized market. Surprise, surprise. And so we do want to show you here, we saw the demand was way up. This is coming off the 22 mark, or 21 to 22. It dipped down as rates went up. This is why our interest rates are such a big deal, that you see the ability to buy and the desire to buy go hand in hand with people buying. Shock, it's kind of surprising. But you see the buyer demand is slowly on the rise as we're heading into 26. So this is where I think something is happening where buyer demand was so high. A lot of these buyers weren't able to buy a house. And so people got stuck with their current situation, whether it's renting or a smaller house they want to be in. And they've been hanging out there for the last 3 years now. And after some time, people have had time to catch up and say, okay, now I'm ready to buy again. And they've also had, they're in their house where for whatever reason they made it work because they got priced out. They're ready now to, like, okay, we got to try again. We got to get out of our situation because there was, for whatever reason, wanted out already. They just weren't able to because they got priced out. So we're seeing a lot of those buyers enter the market as we move forward. And even though prices are up and interest rates are kind of staying up there, we're still seeing, an uptick in buyer demand. Next is population growth. Population growth, Columbus continues to grow at about 1.1% growth, which is a pretty steady growth for Columbus and a population. It's not the fastest growing, city in the country, but it's a healthy growth, and it's causing our market to stay, somewhat relevant. I mean, again, supply and demand, and part of that demand is coming from new growth, from population growth. So if the population is growing, you're more likely to have people that want to buy houses that live here. And the growth in new builds and the amount of houses being built here, sometimes are not able to keep up with some of the growth. You can see here, Columbus is the 14th fastest growing city in the country. This is produced by the Census Bureau. And so this is based on 20, so it's still behind. These government datas are always going to be behind. So everything I'm seeing is still staying very relative to that growth, which is a steady growth. It's not, in my opinion, it's not growing out of control where we're like, it's population's getting too out of control where you can't drive, you can't do things. It's not overwhelming with population, but it's growing enough to keep it steady and healthy. And a growing city is a good thing for most cities. Growing cities bring in energy that, cities that aren't growing just can't have. You can't have industry, you can't have newer things, you can't have new restaurants and industry that's coming here, because if you're not growing, those places are going to go to those places that have growth, because that's where, they know there's more opportunity for those things to come. So growth is good. All right, then the next thing is wage growth. So obviously you have more people, but do you have people that can afford houses, and you have people that are here that can afford houses. So you're seeing here wage growth is a big factor in the ability to buy a house. And this is the country's wage growth. And again, the population growth and wage growth is surprisingly hard to find when it comes to really solid data. This is again, this is supposedly from Visual Capitalist, but it's sourced from the Bureau of Labor Statistics. So you can see here, Columbus or Ohio rose by 2.2%. Again, that is still less than the housing market. So that's even though wage growths are growing, it is less than the housing market. But you got to think if you have two people in a household, 2.2 is closer to 5%. So that is higher than the average price point. So that's where I think that a lot of people are able to say that we are seeing wages grow, somewhat faster in some ways, so people can afford to buy houses and catch up, but not quite fast enough with inflation and everything else that, all the expenses that people have. So that's where it's still about a net neutral if you look at kind of if it's two working adults in a household. All right, new listing and inventory. So this is another thing. So again, supply and demand. This is the supply side of things. The inventory is up 15%. So this is going to, obviously damper the pricing. It's why we saw slow growth because buyers have options. They have more ability to negotiate. And if you don't want a house, you can go to the next house because there's options now. Where in 2020 to 23, there really weren't options. You had to get that house, and if you didn't get it, you had to wait for a new one to come up, and you may be lucky to get that one. So now, buyers feel a little more empowered because there are more options. Um, so inventory is up, finally higher than the pre-pandemic levels. So we're actually seeing them higher than 1918 percentage-wise, and this 2.2 months again is where if no new homes hit the market, it would take 2.2 months for those homes to be sold at the rate homes are selling right now. Obviously, higher interest rates, are going to normalize less, less buyers remember 3%. So this is where, the higher interest rates and normalizing helps inventory because this is something that is here to stay. No one's buying and thinking that they're going to refinance in 2 years to that 3% anymore. With owners that have both low payments and high equity, there's still very few desperate sellers as they have options other than selling for less than value of a home. Um, so this is where the market gets really interesting. This is where we're in kind of a, a lot of talked to a lot of agents, a lot of people. It's a healthier market we've ever been in, but it's kind of a weird market because no one really has, buyers have options, have more inventory, and buyers are being very picky, very, very picky. But sellers still are not desperate. They're not selling, most sellers are not selling because they have to. They're not selling because they're underwater. They're selling because they want to. They're selling because they have a dream of something else. And we're seeing this weird market dynamic where buyers are doing the same thing. We're not in what I call, if you go to the bottom here, a want to market. We're in a want to market. We're not in a have to market. I feel like COVID was a have to market. We had to get out of the apartment. We had to get there. We had to have more space. We're going crazy. Like it's a pain market. We're in so much pain. We got to find something. Where now we're in like more of a pleasure market where we want something, nice, but we don't have to have it. So if the right opportunity comes up, we'll jump. And if we get the right buyer at the right price, we'll sell. If the right house hits the market at the right price, we'll buy it. And that's the market we're in. And so it makes it a very interesting dynamic of, buyers being very picky because prices are up, interest rates are up. They're paying a lot more than they would have 4 years ago. And they know it. And if they're going to pay that much for something, they want it to be, they want it to be what they want. And they're not going to compromise as much as they would have 3 to 4 years ago. So that's the market in a nutshell in 25. I do see that continuing into 26, just to, kind of, jump ahead there. But that's what I think the biggest theme of this last year was, is that we have buyers that, really are dreaming about something better, but yet they're not, desperate to do something. So anyways, moving on to new builds. So new builds obviously are a big factor in inventory as well. And so inventory is really impacted by new builds. But the thing is with new builds is, as long as as long as it costs more to buy an existing home, sorry, as long as it costs more to buy a new build than it does an existing home sales are going to be steady. But what happens is if it costs less to build and buy a new build home, those existing homes are going to struggle. So if you can buy a brand new home for that, but this problem is that these new builds are trying to are more cookie cutter than the existing homes a lot of times, and they're a lot of people think they're not built as well. and the average price is 500, where the existing average price is 325. So it's still less expensive on average to buy a existing home. But that said, most new builds are a little bit bigger than the existing home. You're building a little bit higher in areas because it's not much different to build a house in one area versus the other. But you can get just by being in another area, you can demand more money and more higher price points because you're in an area that people want to be in versus an area that's more affordable. So with that said, you often see the new builds just not in as many affordable cities and affordable areas because of that. And you see here, this is a chart that kind of just shows really the last 50 years how the new build starts really took place. We saw 25. You saw that we actually got past the pre crash numbers of new builds. So I think that's is where we kind of, to be frank with you, we did overbuild, but that was they were trying to catch up from this huge pool gap here that happened after the crash, where pretty much building went to a screeching halt, and we slowly ramped up, then we jumped up right before really the pandemic hit, and all these new builds. What took place is all these new builds actually sold out, and they sold again they sold this new plans before they even dug down to start the builds. They sold all these contracts and they couldn't keep up. And what they did is they oversold and then they built, and they built predicting on this 22 market continuing, and it's slowed down. So now we've seen that slowdown happen. We're seeing this is what happened in really the southeast, as we've seen these new builds really take off and really kind of um, be the reason why we see the flood in the market down there as well, and more options. And a lot of new builds are sitting empty right now. We're seeing new builders trying to do deals to get people in there. So we're seeing more normalization with new builds as well, where it's, there's options. You can go in and negotiate some. You can ask for rate cuts. You can do a lot with new builds right now, even though the existing price is higher. It's not the worst time to consider if you like a new build house. It's not the worst time to consider that because there are options, and there are new build companies trying to offload some of their properties. All right, you can see this is just another chart that talks about new builds, and you see listing change. That black mark is a net unit increase versus household change, and you see kind of how that went the opposite direction. We started with household change way below what we were building, and then that corrected, and we saw the last few years correct again or go back to this market. So that's why we're seeing, you know, we got far enough away from the crash where builders were pretty confident, and we saw 2020 happen, and thinking that this would run for a little longer than it did. All right, cost of living. The next thing is affordability. Affordability has obviously been the big, word of the year, the 25, trying to get things more affordable again. And Columbus on average is still a very affordable city compared to the country. Cost of living, overall here you can see is, housing's less than the national average. Utilities, is equal. Groceries, there's a little bit, is pretty much flat. Transportation's less, so overall we're less, 6% less than the national average on a lot of the major expenses. Uh, this here is shows, this is, country, national numbers, but it shows us that, this, um, the red line is pricing for housing. The blue line is inflation. And you see that, obviously prices spiked up with housing, but so did inflation. Inflation's coming down, prices are coming down as well, but inflation's still outpacing the price of homes, which makes it hard to catch up. Just something to consider here. Inflation's still a little higher than what we want it to be, but it's a much healthier rate than what it was, just 2 years ago. And so it's ticking back up, which is not a great sign. That's why we're seeing a lot of people in with the Fed kind of putting a halt on rate cuts and wanting this number to actually come back down to that closer to that 2% range, and we'll start seeing rate cuts happen again as well. All right, so you see here some number, let me move my face here so you can see here. So this is just kind of some statistics for you. 30-year, rates are all the same, of course. Then you kind of go to the median home sale of the three major cities in Ohio. You look here, Columbus is obviously leading the way. You see the change from last year, and then you see the monthly payment and what it would take to, kind of comfortably make that payment, salary wise. So household salary needed for that. So, that's still well below the if it's two double income salary with the national average, but this is an average price home. So kind of take that with a grain of salt. As you see here, Columbus is obviously the most expensive city in Ohio. Average rent. So that's another factor when it comes to people buying homes is rent increases. People think, well, why should I, rent when I can buy a home? Um, and so the average rent actually went down slightly according to Zillow in the area. Now, you see here, here's the prices, average prices for single family housing at the bottom here. This is actually by uh, apartments.com, I believe. But, you see the average prices for four-bedroom house is close to that 3,000 mark, which you can buy a house and have your payments still today at that space. So, the average, rent for buying a house, when you get up to that 3 to 4 bedroom, it can be close to that same payment. When you look at average payment here is 2021, and you're looking at 29. So, that's, not including a lot of other payments that you have to make, insurance and taxes and stuff like that, but kind of gives you an idea. Okay. Um, Moving on to the affordability, when it comes to other cities, you see here's the top, 13 cities in the country according to Wallet Hub of the affordability index that they create. And you see Columbus is actually, where's Columbus? Is it on here? Oh yeah, Columbus is 39. Sorry. Jump ahead. Columbus is number 39, and they gave it a 66. So it's not like huge difference between the Cleveland is 69. It's literally 3% off. At the same time, the trend is that Columbus continues to be less affordable compared to other cities, and so that is a factor when people think about moving to Columbus. Especially we see a lot of influx from these smaller cities or even bigger cities, but especially smaller cities of Ohio, people moving to Columbus because there's better jobs and it's still affordable compared to moving to New York, LA, Chicago, things like that. So and you see these are mostly smaller towns. You can make a rough, you can make some arguments about are these towns better than Columbus, but still the trend just continues to be less affordable. All right. I want to wrap this up. As I said, I want to try to keep this as brief as possible. So let me wrap this up for you guys and kind of tell you my conclusion, what I believe is going to happen. And I think 26 will continue to be this very similar trends as 25. Now, I know this is not, groundbreaking. I know it's not exciting news, but I think we're going to see slight shifts and nothing drastic this next year. So I think what you saw in 25 will continue to be very similar in 26. So, if that's not a bad thing for a lot of people. And I think this is one of the healthier markets we've been in a while for both buyers and sellers. And we'll talk about that. Affordability would continue to be a main issue. Affordability is going to continue to be the big topic in 26. Can we get housing more affordable? Can we get life more affordable with, everything else that, you need to buy as well? And can you save enough to buy a house? And with slower growth in this, I think we're still on the back end of the correction. When I'm considering the correction of the real estate market, I think we're towards the tail end of it, but we still have a year or two of that. And so where we're going to see slow growth in Columbus area, especially nationally, we'll see again, just like Columbus region, in certain pockets of Columbus, we'll see growth. Some pockets will see negative. We'll go backwards still, and we'll see, some areas have depreciation, some areas have really strong appreciation. And just like the country, we'll see the same thing. We'll see some areas of the country continue to slide down, and some areas of the country continue to take off. Just like we saw in that chart where we saw double digits growth in the Northeast, and we saw double digits loss in Florida. And so affordability will continue to be the main issue. Buyers will be very picky. This is again the theme that kind of my conclusion of 25. I think this is going to continue into 26, where buyers are going to be very picky. They're not desperate. They will pay more and expect more. So they know they're going to pay more than they would have 5 years ago. And they're going to expect more. They're going to expect things to be fixed and taken care of. They don't want things to be, they're not going to buy a house and have to spend $100,000 fixing it up as much as they were. And so they're going to be picky. They're going to want to get what they want and not settle as much as they were in the past. Interest rates will slowly come down and into the year in the high fives. So I believe they'll end the year in the high fives. Will that be the average? I don't think so, but I think the end of the year we'll see high fives going into 27, which will get us into the fives, hopefully level off in the fives for a while as well. Inventory will continue to rise, but much of the inventory will not be desirable homes. So this is kind of one of the, I didn't talk about this earlier, is one of the weird things about this market right now is that even though inventory is up, it's up to what I say, 2.2% or 2.2 days on or months on market essentially, and that's up from like 1.8. And so it's weird if you ask buyers that are looking right now, they'll tell you that the inventory out there is just not desirable inventory. Again, going back to being very picky and not desperate. They're passing on those strange homes or homes that aren't fixed up or homes that are overpriced. That's what the market is. That's what's sitting on the market. What we see happen is homes that are, ready to go, the sellers had made the repairs, they got it ready to hit the market, and they priced it quote unquote fair. Those continue to sell. Those are the ones that are flying off the market. In fact, those are the ones that are getting multiple offers and still selling for over list. We are still seeing that in some areas and with some houses that are ready to go. And so sellers can still win if they take time to prepare to get top dollar. Again, this kind of goes to my next thing. Good homes at fair prices will continue to sell. So if you price your home fair and it's in condition that most buyers are looking for, your home will sell. The weird homes, the homes that need work, the homes that are just overpriced are sitting. So you got to be careful as a seller. Um, and sellers will have to prepare to sell if they want top dollar. Again, 2020 to 23, you put your house in the market and it sold. You probably got multiple offers and it most likely sold with little to no effort. Now that those days are gone, we're back to a normalized market where sellers need to do the work. They need to, fix the things that they should have fixed 10 years ago and they just lived with. That's no longer the case. Buyers will want those fixed, and if you don't fix them, it's going to cost you. The more things that buyers, when they walk through a house, they're making a list, whether literally making a list or subconsciously making a list of the things that are wrong with the house and why they shouldn't buy this house. And the more things that are wrong with the house, the more reasons they don't make an offer. So the things that you can eliminate up front and eliminate those problems with the house, the more likely you are to get an offer and get, maybe multiple offers. And then it comes down to pricing it fair, pricing it based on data and understanding what the market trends are and understand that if you're pricing it in the winter, you can't look at the spring market last year and say this house sold for, $20,000 more, so I should price mine for, $25,000 more because it's been, 6 months. That's not how the market works anymore. So you got to be careful, you got to be wise, you got to have a plan of attack, and you got to understand the market dynamics. Um, we'll see more move up buyers as families are tired of waiting for economics to change. So this is where I think, we'll see more people that wanted to buy something in late 23 when the market shot up or when the prices shot up along with the interest rates that put their search on hold because it got priced out and or the sticker shock of 3% to 7% interest rate. Actually it went up to like 8% interest rate. That sticker shock is kind of done, and those families that need space are going to find find a way to get the space. And so we're going to see more move up buyers opening inventory up for that first time home buyer hopefully, and that higher end homes will be sold to people looking to move up. The low end average price point properties will grow faster than the high end of homes. Again, I kind of see that as there's still, plenty of people looking for their first house. That's always going to be the average. The lower end prices are always going to grow typically faster. So it's kind of I just see that happening within higher end homes, especially are going to tend to slow down. We'll see modest growth, 3% or more. So this is growth when it comes to price and homes sold. So 3% or more when it comes to the percent of homes sell, like the more 3% more than last year sales, and then modest price growth of 3 to 5%. Again, very similar to last year. I think we're going to see a little bit more uptick, even though some of the market trends are pointing to the idea of it being a little bit maybe less affordable. Prices are up a little bit. Interest rates are kind of often the same. I think there's enough people that have waited longer that are waiting on the sidelines, are tired of waiting on the sidelines, that are going to jump into the market, and people are going to find ways. People are the bubble or the correction that's been taking place, and people have been able to wait and save now that they can make a decision to buy a house. And so I think we're going to see more of that, which is why I think we're going to see slightly higher growth than we saw this last year, but not much, very minimal. And again, it's going to come down to location, location. Certain areas are still booming. Certain areas are still exceeding multiple offers on average. Certain areas are still seeing higher than average, or higher, days on, the price listed is still higher than the price being sold at. So we're still seeing some of that, just very few and far between. And location really matters. So if you're looking to buy, you need to know what your location is doing in Columbus region, even. And the Columbus region is still a very, competitive market. It's just not, it's a more normalized market. So there's things that people are looking for. If you're looking for a brand new, a house that has a lot of character, but that has no issues, and it's move-in ready, and it has an updated kitchen and bath with an outdoor space, those are probably going to fly off the shelf. But a house that needs completely renovated and gutted, it could be a $200,000 to $300,000 difference than the house that I just talked about, because the cost of construction is so much higher, and buyers know that now. The days of a buyer coming into a house and saying, "Oh, for 5K, I can just redo the kitchen," are long, long gone. So that's, you got to add a couple more zeros to that now to get what people want. And so buyers understand that. They understand it's going to cost more to renovate, and they don't have as much extra cash as they used to when it comes to purchasing as well. So that's why, you got to be savvy when you're looking at buying, and you got to be savvy when you're looking at selling, more so than I think you did in the last few years. So lastly, I just want to kind of recap with what Realtor.com kind of talks about. I think Realtor.com has become kind of the leading kind of data analysts on when the market's doing when it comes to all the players in the real estate world. I kind of feel like Realtor.com does the best job of making these predictions and kind of moving forward. And they did a really good job last year. So I kind of want to just stack up what I said. This is again just a national prediction they have. So they have mortgage rates in the 6.3 range. So they think it's actually going to stay where it's at right now and just flatline on average on year end. So just a note there. Median home price, I think, is going to rise 2.2% across the board. That was it was 2% this year, so it's very, very, very marginal difference there. And I think that more home sales are going to take place, and 1.7 compared to basically flatlining from the year before. And existing inventory is going to actually slow down, or no, sorry, it's just not going to grow quite as fast. So I think existing inventory is going to grow a little slower, still grow, but slower at 8.9% compared to 15.2. Single family home starts will, again, same thing, will still increase by 3.1%, but that's less down from 4.3%. And home ownership rate will slow down. And then rent growth will also slow down. So that's an interesting one. The rent growth will continue to kind of correct off the pandemic highs. So, well, thank you for tuning in. I really appreciate you. If you've stuck through this whole video, appreciate you sticking around. Love to connect with you. Reach out if you have a question, comment. Please leave a question and comment. Subscribe to this page. I do put out a monthly market update to keep you informed what's going on a monthly basis. But this is my yearly show. This is what I do on a year in, year out basis to try to say, hey, give you the confidence to make a decision in 2026. And again, I don't see anything drastically changing in 26. So, if you're, hey, I need to sit on the sideline and save some more, that's okay. Or if you're like, I want to buy a house and not make a huge mistake, now's the time for that too. So that's where I think there's nothing here that I'm seeing, outside of something crazy happening, is the market really imploding in Columbus. So, with that said, the big thing that I would say as I think about that is Intel. The Intel bump happened in the 2020 market as well. There's been a lot of rocky things happening at Intel. There's still a lot of confidence that's going to move forward. There's still a lot of talk, though, that it's not. But at the same time, we saw other things happening that kind of, actually is going to create more job growth than Intel with the Anduril and a lot of other things still coming here, where I think there's definitely still a really solid future for the Columbus, Ohio region. Even if Intel does not happen, I know the far east side of Columbus may definitely see an impact of that. But as a whole, the Columbus region is still a very solid area with job growth and population growth and income growth along with it, keeping the prices steady here in Columbus. So Again, thanks for tuning in. That's my recap. I would love to talk to you and connect with you in person as well. Thanks.